As we try to sort through a really tumultuous week, what really affected the markets and what was just a feint?
Well, I think the combination of the virus and the Fed is sort of the perfect storm because on one hand, you had the Omicron virus holding back certain parts of the market, such as the reopening trade. And on the other hand, the March 22 COVID playbook was completely crushed by the Fed because if you think about who that was, it was the beneficiaries of cheap money, such as your Pelotons, your stay at home, and no other manager really exemplifies that trade as well as Cathie Wood. And if you look at her fund, ARK is down 16% since Thanksgiving Day when we learned of the virus. And typically you would have thought that would have been your go-to playbook. So what this means is you need a new playbook this time. The Fed's change of stance is very material.
So, Rebecca, I'm curious about that change of stance from the Fed. Is it a change of stance in that we know that they're going to taper and that they're ultimately going to hike, or is it rather, let's improve our options?
I think it's the latter, really. The Fed is trying to make sure it has optionality. It's still not sure if inflation is going to be where, quite a bit lower next year or quite a bit higher next year. But by speeding up the taper, you can address inflation expectations, make sure they don't de-anchor now. You finish the taper, and that's completely separate from tightening. So if inflation stays high, and we think the risk is that inflation could stay high, housing supply is going to take a long time to come back, labor is going to take a while to come back, energy, commodities, those supplies are going to take a while to come back. So that inflation pressure is going to last. If that's true, then the Fed can raise rates faster. And right now, we only have 2 hikes priced in for the second half of next year. So there is room for more to get priced in, and that can push yields back up just as fast as they came down this week.
Yeah, exactly. A very powerful point. Barbara, and let's talk about that inflation issue. If, in fact, it stays up, are you starting to see it sort out some of the stocks? You get involved in individual stocks. Are there certain stocks you want to go to in a high inflation world?
Oh, absolutely. I mean, I'm very fond of green metals, for example, and they're a beneficiary of inflation. And I think every portfolio is woefully underallocated to them. But I think, what the market's telling you right now is that the Fed might be doing a deflationary lower growth policy mistake. The markets are expensive, whether it's a stock or a market, David. Punching multiples hate lower growth. And that's what people are afraid of, is that we will have lower growth. And so you'll see multiple contractions. So the stocks that you absolutely want to stay away from are sort of what I would call those, speculative bubble ones where they have no earnings, and that game is sort of over. So it's more right now, how do you protect yourself from things that have been beneficiaries of this environment?
Well, let's pick up on that just for a moment, because one interesting thing at the end of the week I saw from Charlie Munger, actually, Warren Buffett's partner, is pointing out how many of the NASDAQ 100 stocks actually are below their 52-day low as opposed to above. And it's sort of a record number. It's like 588 of 3,500 or something like that. Are we seeing something like a bursting of some of the tech bubble?
Well, we try to monitor for bubbles in the stock market, and based on our own calculations, there's probably about 10% of the U.S. stock market that we would consider frothy. But the bulk of it, we think, is fairly valued. And a lot of the stocks that we think are frothy are in that speculative camp, right? We also know from the U.S. that over the last decade or so, we've gotten more U.S. stocks that are very sensitive to liquidity conditions. So picking up on what Barbara was saying, to the degree the Fed is forced to tighten faster than is discounted to address inflation, you do have a section of U.S. stocks that are going to be more vulnerable to that than they would in past cycles. Same time, I'm not seeing any evidence yet that growth is slowing. This is a fear tied to the Fed, a fear tied to Omicron rather than a reality. And we think there's a good chance you're going to have a self-reinforcing cycle next year with inventories rebuilding, CapEx spending, wages going up, helping the consumer. And if that's the case, then there's going to be plenty of stocks that are going to benefit from that probably aren't that overvalued right now.
So, Barbara, let's pick up on that just for a moment with the Omicron, because we started the week really pretty concerned about it. That concern seemed to wane during the course of the week. But some people were saying we might end up with the worst of both worlds, which is, on the one hand, suppressed growth because of Omicron, if it really comes back strong. At the same time, increased inflation because it may affect, for example, supply chains.
I think that's right. And I think this is where we need to be very clear. There's more than one source of inflation. It's not all monetary, right? Supply chains are a source of inflation, and the virus could exacerbate that due to lockdowns and travel restrictions. If you look at energy, we have an energy crisis in Europe and China. last month, the PPI in China was up 13.5% on the back of higher energy. The PPI becomes the CPI. And if you think about the cost of energy, that's nature's discount rate, and it impacts every industry. So I think energy is a real source of inflation. Then you look at food prices, they're up 30% year on year, in part because the price of ammonia has gone from $100 a ton to $1,000 a ton in a year. So, and then you look at shipping costs. We all know the price of a container was $2,500 pre-pandemic. It's $25,000 today. And lastly, nearshoring. We've gone from just in time to just in case. You know, McKinsey put out this report and it said 92% of their clients had invested in nearshoring to bolster the resiliency of their company. And you just have to look at someone like Ford and GM, who are doing deals with chip suppliers to manufacture domestically. That is inflationary. So if you think about one of the sources of deflation for the last 25 years has been China. And if they are no longer going to be a source of deflation, this is a radically different, this is inflation due to structural issues. And this is something the Fed can't fix. So I think inflation is here to stay for longer. And call me crazy, but it might not be the worst thing in the world because you can inflate your way out of debt. And what COVID did was it took our debt to GDP up to 125%. And it's never been higher than that, not even during World War II. And one way to delever is to inflate your way out of it. So I love that the Fed dropped the word transitory. I'm just waiting for them to say it's necessary.
Well, this is a favorite topic, I think, at Bridgewater, actually. You inflate your way out of debt by deflating the value of the currency is really what that does, right? It discounts the currency. Is that a good way out of this?
Well, if you have to choose between a deflationary depression and modest inflation, both of them have costs and benefits, but the cost of inflating your way out is going to be spread a lot more evenly across different cohorts than a deflationary depression. So if I had to pick one, I would completely agree. Setting inflation at a higher level is probably going to be a much less painful way to deal with our debt.
Let me ask you one last question here before we go to the break, and that is, you mentioned liquidity. The cost of capital for a lot of companies has been approaching zero for a long time. Has that really saved a lot of companies or promoted companies that otherwise would have to make some tough decisions?
Yeah, I think that, look, it's important to remember tapering is not tightening, right? So if we're tapering, we're still adding liquidity to the system, just at a slower rate. So liquidity conditions are starting to normalize, but we're not tightening that quickly yet. That could change next year if inflation stays high, and I'm sympathetic to the points Barbara was making. But I do think that what COVID did is it released this coordinated fiscal and monetary stimulus, the biggest stimulus we've seen outside of wartime in modern history. And it's meant that balance sheets for companies and households are much, much stronger. And so, yes, there is some risk as liquidity conditions tighten and cost of capital goes up. But the starting point for companies and households is extremely strong right now. So that could help prolong this cycle for longer.